Good morning and welcome to this Monday, March 29th, 2021 edition of Trading Places Live at Earnings Beats. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Oh, well, it looks like futures a little mixed overnight, turning a little bit lower this morning. News about banks having some issues with margin calls relating to some of the trading last week in Viacom and Discovery and some others. Of course, Viacom, one of our portfolio stocks, which had done extremely well up until about a week ago. And there were some options issues on Viacom, and the stock started to pull back, but things really began to turn more into a rout later in the week as certain banks struggled. I think Credit Suisse was one in particular that is in position to suffer some pretty big losses. And all of that is having an impact on futures this morning. Of course, it's Monday. Mondays, for me anyway, knowing the history, I don't get too excited about Monday mornings. We do tend to see more weakness on Mondays than we do throughout the other days of the calendar week. So waking up to red futures on Monday morning for me is kind of a normal thing. But we do have right now, I think Dow futures, S&P futures, NAS futures are all down in that 0.4% to about 0.5%. Excuse me. So it does look like we'll get off to a little bit of a rough start to begin the day. We're going to get into all of that in just a minute. But I do want to take you over to Earnings Beats if you're new, just to make sure you're aware. We do have a free Earnings Beats Digest newsletter. Just simply type in your name, email address, hit the subscribe button. No credit card required. We'll unsubscribe you at any time you wish. Just let us know. But it is very educational in nature. We just try to give you some knowledge to approach the market. This morning, talked a little bit about, well, over the weekend, I wrote an article, excuse me, in Chart Watchers regarding earnings season and just, this whole buy on rumor, sell on news. I mean, when I think of buy on rumor, sell on news, I think of earnings to me more than anything else. There could be other news, in a particular stock that's coming out and it's not supposed to leak, but certainly does look a little interesting sometimes when you see a stock go up for a week or two, and make a pretty big move, and then some big announcement comes out. It makes you scratch your head sometimes and wonder, was it just coincidence or were there buyers ahead of the news? But with earnings, there's no question in my mind. I mean, that is buy on rumor, sell on news, or sell on rumor, buy on news. Can go both ways. But, understanding the fact that Wall Street firms go out and right up until the end of the quarter, the calendar quarter or the quarter end for a company, Wall Street can go out, talk to analysts, and then they go into a quiet period where they're not allowed to or technically not supposed to be in touch with company management as the quarterly report, all the final stuff is done and numbers come out. But up until the end of the quarter, management gets calls from Wall Street firms. They go out, they visit analysts, sit down, talk with management. I mean, these are things that we can't do. You and I can't do it, but Wall Street firms do. And so following the charts helps us get a better sense of what is likely to occur. If a stock is going up and it's going up faster than its peers and it's, got some decent volume, showing a good accumulation distribution line. I mean, all of those factors would suggest and maybe give us a little bit more comfort and confidence that a company is going to come out with good numbers. Anyhow, I talked about that a little bit on Saturday in the Chart Watchers newsletter, and I pulled up specific examples of how the stock market runs higher into the first few weeks of a calendar quarter. And really, the numbers I gave were for the first 6 weeks of a calendar quarter versus the second 6 weeks. So in other words, January 1st to February 15th versus February 15th to March 31st, and did that with each of the 4 quarters. And what you're going to find is that over the last 70 years, the stock market does a lot better in the first 45 days of a quarter than it does in the second 45 days of a quarter. Now, you can attribute that to whatever you want, but for me, it's clearly a sign of buy on rumor, sell on news. Buy as the earnings are about to come out or as they're coming out. Earnings normally are going to start to come out about the middle part of April, and they'll last until about the middle part of May. And I mean, there's a lot of other companies that report outside. I'm talking about the lion's share, the majority of earnings come out in that period. And so you've got a lot of folks that are buying ahead of that based on, what Wall Street sees. So Wall Street goes out, talks to management, goes back to their office. They're buying stocks for themselves, for their clients, and so forth. And then you've got the news that comes out. And then after the news is all out, there's nothing to send prices higher. And many times that's when we start to see a little bit of weakness in those aggressive areas. I mean, perfect example has been March of 2021. I mean, we saw, pretty nice run-ups in a lot of areas, but over the past 4 to 6 weeks, especially the growth stocks have taken it on the chin. And if you look at I'll pull up that growth stock chart for you. This is the IWF. Now you can see we were moving along pretty good until the middle part of February. And, right at middle February, we start to see the selling. And here we are, still way off those earlier highs. And now we'll see what happens as we get ready to go into April. Do we start to pick back up again? Well, you got to look for technical clues. Doesn't mean there's no guarantee we're going higher. But if we start trading back above these moving averages, that would be a pretty good sign, as long as we can stay above them. And then once we break out again, I think that would be obviously the best sign of all. But, you got to take it one step at a time. But it's worth pointing out, you can kind of see that occurred right there at the middle part of February, at least in terms of growth stocks this quarter. But anyway, getting back to Earnings Beat, you just simply type in your name, email address, hit that subscribe button. Again, you can unsubscribe at any time. It is a completely free newsletter, no credit card required. We'd love to have you. In that newsletter, though, I talked about Shopify, giving examples. This is a company over the last 5 quarters that's averaged going up 45% into its earnings report over an average period of about 5 weeks. Well, this morning in the Earnings Beats Digest, just to give you an example, I threw out Tesla, and Tesla has actually outperformed Shopify heading into its earnings reports. It's let me see, I'll give you the last 5 quarters. The last 5 quarters. So in January, from the end of December through the first 4 weeks of January, Tesla went up 25% in the 5 weeks before earnings. In October of 2020, it went up 20% in the last 4 weeks before earnings. In July, late June through the July 22nd earnings report, Tesla went up 70% in 4 weeks before earnings. April 29th was their earnings report last year. From April 2nd to April 29th, went up 78%, Tesla. And then January 29th, they reported, January 29th of 2020. And from December 31st to January 29th, which was roughly 4 weeks, Tesla went up 45%. This is the last 5 quarters. Now, I'm not telling you Tesla is going to go up 50% in the next 4 or 5 weeks. But if that report's going to be strong, you're going to probably start to see it in the charts before the report comes out. It's not going to be a shock to everyone. So Wall Street knows. We've seen a big sell-off in Tesla over the past 6 weeks or so. A lot of folks are writing them off. I am not writing them off, I can tell you that. I think it's going to be one of the fastest growers of the next several years. Now, does Tesla come roaring back this quarter? We're going to find out. I do believe it's a great long-term company, though. And I think the charts bear me out on that. And this is one we've been talking about for a long time. But anyway, that was a Earnings Beats Digest article this morning talking about Tesla. So again, get some pretty good information in there. So love to have you sign up if you get a chance. Moving on to the market from Friday, we saw the Dow Jones Industrial Average up 453 points, S&P 65, NASDAQ 161, big reversal there. Mid caps were up 2.3%, small caps 2.4%. Welcome back, mid cap and small cap stocks. Been a while. We had been underperforming for a little while. Nice rally there. The good news was we finished really strong in the afternoon. Last hour was particularly strong in the market. Sometimes I think, well, that means we're going to have a big gap up on Monday morning. Well, I don't know. Sometimes the Monday blues catch the market. You got the weekend for stories to come out and so forth. A story, the came out about the banks and the margin calls that are hitting in some of the banks, especially Credit Suisse, that are going to take a big hit to their earnings as a result. All of that, plays into the emotions and the psyche as we go in and open up trading today. We'll see how the banks are not going to have a good day. At least they're not going to have a good open. We'll see what happens after that. But this has been a market that's been favoring banks for quite a while. So it's just rotation. You throw out the story you want, but the stocks are going to rotate. We're going to see rotation. The key for me, it's just like with technology. Yes, market rotated out of technology. That's the bad news. The good news, the market really didn't take a hit. Technology, because it's so heavy on the NASDAQ, definitely had an impact on the NASDAQ, but it has lesser of an impact on the S&P. The S&P closed at an all-time high on Friday. So the good news is that money is not leaving the market. It might be leaving technology temporarily, but it's finding a home in other areas. That is the hallmark of a secular bull market. Money rotates. It doesn't leave the market, it rotates. And so anyway, starting off this week, we're going to see some rotation out of banks. We'll see if something else picks up. Maybe it'll be technology, maybe not. Maybe it'll be materials and energy. Big days on Friday in both those areas. You can see down here, materials up 2.48%. Technology actually was the big winner. I don't know why I got the order here mixed up, but technology 2.54%, materials 2.48%. Then you got energy 2.48%, real estate 2.44%. But on the other side, communication services. Now, communication services just recently had been one of the leaders. Now, all of a sudden, you can see the rotation out of communication services. And you're going to find media agencies in here and media stocks like Viacom taking a big hit last week, leading that move to the downside. So again, rotation, when I look across at all these charts, yes, technology's taking a big hit. I still see an inverse head and shoulder pattern that potentially would be very bullish on a breakout above 135. Don't know if we get it. I do look for bullish patterns when I believe we're in a secular bull market, which I've been talking about for many, many months. And so I look for bullish patterns when we get these sideways consolidation periods. And even though technology is not leading right now, you're not going to have technology lead every single day, every week, every month throughout the entire secular bull market. You'll go through periods where technology lags, and that's what we've been in. But a breakout back above 135, I think, would be bullish. 10-year Treasury yield. Not really much out in terms of economic news today. So let me get you an update here, see where we are. Right now, we're down less than 1 basis point, 1.65%. I'm not going to go into it, but I have, written articles. I've talked about it on the shows, put it in the DMR, our daily market report that goes out to members every day. But I've talked about the fact that the 10-year Treasury yield went up in 2016 to 2018 from 1.4 to 3.25%. During that period, technology outperformed. I don't know if it was the best sector. I want to say it was the best sector, but it was definitely one of the best sectors during that huge run-up in the 10-year Treasury yield. And yet this time, the big run-up in the 10-year Treasury yield is the reason the technology stocks are selling off. And I say that somewhat sarcastically. If earnings growth is 6.5% or higher in 2021, I got to believe technology is going to get its fair share of that growth. An economy is not going to grow like that, and technology just take a back seat and not grow. That's not going to happen. So it's not a question to me of whether or not technology grows. It's really just a question of, do they outperform on a relative basis? And that's what we'll be watching. First step, like I said on that chart on the XLK, break above 135. Little baby steps. Got to get through key areas, short-term resistance levels first. You can't just shoot from where we are in technology to be a leader again, in another day or two. It's going to take some time. It may take several weeks to see technology return back to a leadership role. It might be, who knows, maybe it's the fall before we see it. I mean, we're going to be able to follow it on the relative strength charts, and that's what we'll be doing. But the TNX right now, definitely in an uptrend. I could see this, with the strength that's being forecast and the inflation scares that we're going to see over the next couple of months. I could definitely see the 10-year Treasury yield above 2%, 2.5%, maybe even higher down the road. That's not horrible. Don't let the media tell you that's horrible. We've been needing a little bit of inflation. The Fed's been trying to pump inflation into our economy. You need a little bit of that. That's not bearish for stocks. You also need to see the economy rebound. We can't be in this thing where it's just the Fed handing out money or Congress handing out money to everybody. I mean, that's not the way you grow your economy. That's not the way we want to grow the economy. That's the way we're stopgapping some of the issues we've had. But that's not a long-term solution. That's a short-term bridge to try to get the economy healthy again. Now the economy is getting healthy. Now the economy is forecast to really strengthen. And all of a sudden, that's a bad thing for the stock market. Anyhow, yeah, I don't have any problems with 10-year Treasury yield going higher. It's a shock to some. It's going to be a headline story. It's going to try to scare a lot of folks. And again, I can only imagine the next 3 months as these inflation reports come out, because the inflation numbers are going to be higher than expected. I mean, we're going to see, I think the core rate could get onto a path of close to 3%, which is well above the Fed's target 2% level. We'll see. The Fed's saying it's going to go above 2. I think it could go as high as 3, but I think it'll settle back down again. And that's what the Fed's been talking about. But even that we'll see over time. Check and see what these upcoming quarters look like. But these quarters coming up over the next couple of months are going to be replacing months, not quarters. The upcoming months are going to be replacing months from last year where we saw negative inflation. We saw deflation for 3 months during the initial stages of the pandemic. March, April, May were all negative. They're going to be replaced with positive numbers. And so the year-over-year numbers are going to jump. It's mathematical certainty. So don't be shocked when you start seeing the headlines. Now, the market may react negatively because that's what the market does. I don't think it's going to be a problem long term. All right, let's move on. Take a look at a few sectors, a couple of the sectors. I always talk about technology, consumer discretionary. I mean, here's a 1-year chart of technology. I mean, if you just looked at it a year ago, you'd have been ecstatic to see, oh my gosh, where we were in the depth of the pandemic. The XLK was at 75. That was in April. It was actually much lower than that, I think, back in middle March or March 23rd. But just look, from 75, we're at 132 now. Now, there's some are saying, oh, it's a bubble. It's a bubble. We've gone up so much in the last year. But again, you lose perspective when you're just looking at the last year. You need to look out further than that. So if you come down, and by the way, even though technology continued pushing higher, notice the relative high was set all the way back in September, right here. And I actually wrote an article that day, September 3rd, saying that the market looked like it was toppy. Market was moving up, but so was volatility. That was one pretty big warning sign. But there were just a lot of, not signs for the big picture, but signs that we had run a lot and it was time to pause for a while. And while on a absolute basis, we broke back out again, on a relative basis, we did not. We have not cleared that high that the XLK set versus the S&P all the way back in September. And yet we've gone higher. So, and look at where we are right now. I mean, the relative strength of technology earlier in March, that first week when we took the big hit, you can see that relative strength line dropped all the way down to the July level, or close to the July low. A lot of folks writing off technology, but I'd be careful in doing that. I really think, and when I was talking about, watching the XLK to see if we can break above that 135 level right here, get through this neckline, this double top. If you can't see it, left shoulder, you rise back up, left side of the neckline, lower low puts in the head, come back up, right side of the neckline, you come back down, right shoulder, almost perfectly symmetrical with the left shoulder, came back up on Friday. I think right now the XLK is in this range, 127.50 versus 135. Break above 135 is one thing to look for. Another thing to look for would be taking out this relative high from mid-March at about 0.0338, just below that. So if you see it climb back up above that, then you're starting to see money rotating back into technology at the same time as a breakout. Or even if we don't get the price breakout, if we start to see money rotating back into technology, I think that would be a really good positive sign. Right now, we've got this downtrend in play. So it would just be nice to see that break and a push back to the upside. XLY. Excuse me. All right, XLY, consumer discretionary, not nearly as bad as technology. If we go down here and look on a relative basis, yes, first week of March was bad. We had a little bit bigger bounce. We actually did set a new 52-week relative high at the beginning of February, just before we saw a lot of money rotate out of consumer discretionary. You can see it there on the absolute chart. But I think we put in a fairly significant bottom right there. I'd be really surprised if we go back anytime soon and take that level out. I think to the upside, we got to watch 170. That's that reaction high off of this low. And then obviously the all-time high back on February 8th. So those would be a couple levels to watch there. The XLC was just humming along until late last week. And then with the issues with Viacom, that took down some of the media companies. And we've got all the way back down to the 50-day moving average. I wouldn't be surprised to see a little bit more pressure here, although I think the breakout around $70. If we do go a little bit below the 50, we've done that, before during this uptrend. I think probably that $70 area is going to be a pretty good support level for the XLC. Then we got the financials. Financials, I think, might come under pressure a little bit. This could have been a little top. We had a false breakout about a week ago, came back down, failed to hold it. And then, of course, going into option expiration, a lot of the financials, were looking pretty good. Lots of in-the-money calls. So shouldn't be too shocking that we fell from 35 and change down to 33. That saved a lot of money for the market makers into option expiration Friday and then into the first 2 days of last week. But overall, this is a nice uptrend. I mean, we could go back down even as low as 32, I think here. 50-day test, maybe this recent low or even this breakout. Let's call it 31.5, 32. I think financials, which have had a huge move leading the market to the upside, you can see the relative strength here. So this is what I'm talking about, rotation. And when I see rotation, I like rotation between the aggressive groups. So when technology takes a hit, I like to see consumer discretionary or financials or something else pick up that load and go forward. That's what we've seen here with not just financials, but also with industrials. Let's pull the industrials up. Here you can see the breakout on Friday. We just broke out on industrials. Look at the relative strength here. Very, very strong in industrial. So this is good news, good action. And, technically, as we're rising, look at these, the holds of the 20-day moving average. When you're trending, that's what you generally see. When you're moving up and that PPO is moving up, when you pull back and hit that 20-period moving average, that is usually your buy point. I especially like when you break below the 20 and come back up and close above it in that same period, the same day. We saw that actually back on Thursday. Nice recovery, and then look at Friday breaking out. So overall, I mean, I think the market's still in really good shape. My biggest fear going into this last quarter in terms of our portfolios was rotation. It wasn't whether the S&P 500 was going to go to a new high. I believed we were going higher. I still believe we're going higher. I think we're going a lot higher. The question is just relative strength. And I believe what's happening is we're getting a normalization. The groups that underperformed are now showing leadership, getting back to a certain point. But at the end of the day, the valuations, the companies that are going to command the higher valuations are the companies that can sustain earnings growth, a higher rate of earnings growth over an extended period of time. And I think eventually that gets back to your technology and consumer discretionary names. Maybe some of the industrials. I think financials are going to do well because interest rates are going to continue to go up. I really don't see anything bad on the horizon outside of the headline news and some of the short-term weakness we're seeing right now in technology. All right, one thing I wanted to show you, in case you haven't seen it before, is, when I do the like if I'm going to show you beginning of the show, I always, bring up 10 charts and show you in candle glance form. Now I'm going to show you how you can do the candle glance. I just, clicked on the view so you could see here how you do it. So once you're in your chart list, you just hit this view all, and then you hit candle glance on this drop down menu. That's how you get to it. But how do you actually set the charts up? And so what I thought I would do is let's go ahead and move over here. So first thing you want to do is pick out a style that you want to use. For how do you want the charts to look? I normally, when I do a candle glance, I shorten it because you get too much data, it's hard to see. So I normally will pick like a 4-month, or you could even do like a 2-month daily chart. I still want to do candlesticks. Could have the volume. I've got my 50 and 20. Let me get rid of the 50. I'll just do the 20-day since it's a short-term chart. PPO is fine. Maybe I'll do the AD line at the bottom instead of RSI. And so now you just update the chart. Okay, so this is what I want it to look like on my candle glance. Now I've already set up a style button for candle glance. If you haven't, you have to hit this plus button. And even if you have, you have to hit this plus button. But when I type in candle glance in chart description, mine will automatically come up because I've already got a button set up for candle glance. If you don't already have one set up, type it in here, just like they've done it here, candle glance. I don't know what'll happen if you type in a space in here, but I would just do it the way they've done it. Candle glance, C and G capitalized, no space. And then I'm going to hit replace, but I think probably you would hit new if it's new, or whatever they ask it, maybe add, I don't know, whatever it is, but I'm going to hit replace. So now what'll happen is when I go down here to view all, I'm going to go into one of our chart lists. We just updated our chart list, by the way, last night. Strong earnings, both the strong earnings, strong future earnings, raised guidance, all of those were updated. But I'll pull up raised guidance, and I'm going to view all, and I'm going to do candle glance. Now you can see I've got a 2-month chart. There's my PPO, here's my volume, and here's my AD line. That's how you set it up so that it's your default. So that when you pull up the candle glance, what Stock Charts does, it looks over to those style buttons to see what you have picked. Now, I'm sure Stock Charts probably has a default that they use in the event you haven't set something up in your account. But if you want to see it your way, do it like this. Now I've got all of these candle glance charts set up for my raised guidance chart list. And I can quickly, there might be something short term that I'm really looking for. Maybe it's a breakout over recent highs. You can see Micron has this double top. So, it'd be nice to see a breakout there. But you can kind of get a quick look. Here's another double top on Progress Software, and maybe a little bit of a double bottom there, although it did break down temporarily. But yeah, I'm just kind of looking to see, and I can, flip through wherever charts I want, just quickly look. But I think candle glance features a really cool part of stock charts. So I just wanted to show you that. Now, and you can set up any style you want, doing exactly what I just did here. So here's my default chart, but set your chart up however you want, and then just simply come over here, hit the plus button, and then just call it whatever you want to call it. My favorite chart, whatever you want to call it, and you can add that new. And once you add it, then you'll have a button. And when you go over it, it'll say my favorite chart. Now, of course, I didn't save it. But there you can kind of see. So you've got all these different buttons so that if I'm looking at Tesla and I'm like, okay, I want to see a weekly chart. Well, it really gets tiresome to come down here and hit weekly and then move it out to 5 years. And then if I want to change and look at, the AD line instead of the RSI, coming down here every time to make the change is really cumbersome. But if I have a chart style already set up for weekly, I just hit the button. There's my weekly chart on Tesla. Oh, wait, I want to see the 5-minute chart or 10-minute chart. There it is. What about the relative strength chart? There it is. See how much quicker I can use the service, the platform? That's really important. And I talk about it every once in a while, but I just want to make sure everyone's aware of that. All right. Let's see. Earnings, not really much in the way of earnings coming out. Today, CALM market just opened. So let's see. CALM, which is in the food area, I believe. They missed on their earnings, 28 cents versus 39 cents. Hasn't opened yet. Not a very good report, though. Let me try again, see if we get a number. Here we go. All right, so it gapped down at the open. This is actually a pretty good area of price support, getting down here at the 50-day and this triple top early that we broke out of. But be careful if the stock were to break back below the 50-day today. Not one of my favorite charts, by the way. I mean, when I look at we've been in a really nice bull market. When I look at a stock like this that has done nothing throughout the entire bull market, not really going to be interested. And this is in, the consumer staples area. And so you can see relative to the S&P, it's been horrible. The group relative to the S&P has been horrible. The stock relative to its peers have been horrible. I'm not interested. And then you look and you see the earnings report with a 28-cent bottom line. Market was expecting 39. Now, do you know why the stock has been trading so poorly? Again, I talked about buy on rumor, sell on news. Well, in this case, it's sell on rumor. And sell on rumor, you can see it even more in the relative strength over the last several months. And then buy on the news. It sold off, and then the news comes out, and now we're seeing a little bit of strength coming out. Maybe we get a little bit of bounce off of this. But again, longer term, I'm not really interested. Let's wrap up today with the 3 you must see. I'm going to pull up 3 charts that I think look really interesting, and I'll update them to show you what's happening today. But this was Pulte Homes on Friday. Look at the break. First, it held its 20-day moving average, breaks back out. Look at its AD line. Of the 3 I'm going to show you, this is the one that's got the strongest AD. You look at the home builders breaking out. Now, Pulte is not one of the better stocks within the group. So what that tells me is if I buy it, I do not want to make excuses for it if it fails to hold support levels. In other words, it bottomed in relative strength back at the end of January. I need to see this relative strength line continuing to go up, and I need to see the price chart continue to go up. I mean, you have pullbacks, a little profit taking along the way, but I'm talking about significant pullback. I do not want to see the stock trading back down below 47.5. I can tell you that. Based on being one of the weakest stocks in the group, I would not be interested. But that's a lot of consolidation in Pulte Home before finally making the breakout, and the volume's picked up. Now let's see what's happening today. Continued going higher. So we're up another 1.2%. So looking pretty good. Best entry is going to be rising 20-day moving average. Should have a little price support around 51, but that rising 20-day, when you do get a test there, that's where I would be looking for a bounce. Next up is EQT. I'm going to give you 3 different industry groups, 3 different sectors. Of course, Pulte Homes, home builder, consumer discretionary. Now you got EQT. This is in the energy space. Made the breakout on Friday. AD line starting to turn up, but you can see really hasn't been doing much. Looking down at relative strength, this is another one that has not been very solid, but it has started to show relative strength. So it's making a breakout. It's starting to show relative strength, and this is another one where I want to see both absolute and relative strength continue. Then the final one, and this is a stock that I think really looks good, Network Appliance. Network Appliance, after making a huge move up, look at this sideways consolidation, finally breaking out in November with that vaccine news. It has been straight up, probably negative divergence. Just looks to me like momentum is slowing here. Ended up coming down, but what happened? Came up, we put in a cup off of this uptrend. Cup, handle back to the 20-day, breakout. That is almost textbook to me. So I really like this breakout on Network Appliance. Any kind of a pullback back into the low 70s, I think would be a great opportunity into Network Appliance. I think this is a really strong looking stock. And look at the relative strength versus computer hardware. So this one is showing relative strength. AD line's okay. It had a huge run back here. Lots of accumulation. And I think lately it's just been going more sideways as the stock consolidated. But I would be looking for maybe this to pick up again, along with that continuing relative strength. All right, that's it. Let's get a quick look at the market, see where we are. Right now, NASDAQ, S&P, Dow, all down about 0.2%. Not horrible, but not anything to write home about, that's for sure. We'll see how the rest of the week turns out. We are going into April, thankfully. This has been a rough month for us at Earnings Beats in terms of our portfolios, and really anyone that is focused on growth. And just to, I wasn't trying to make excuses. In the weekly portfolio report yesterday, I put in there and I just showed what some of the other funds, ETFs that are invested that have a theme that focuses on growth stocks. I looked at all the ARK funds. I looked at that Nifty 50 IBD fund. These are funds that have been massive outperformers because they focus on the best companies, the companies that are growing their earnings the strongest. And when you look at what they've done since mid-February, we're kind of in that boat. In fact, ARK funds, all their funds are down. I think most of their funds are down over 20% since the high. The Nifty 50 IBD is down 10% plus. And that's kind of about where our portfolios are. I think we're anywhere from 7 to 11, our aggressive portfolios, the model, aggressive, strong AD. I don't think it's so much stock selection as it is just the baby being thrown out with the bathwater. It's growth stocks, and we don't care if you're a growth stock, we're selling you. And I think that's going to change. Now, whether it changes here during earnings season, I guess we're going to find out. But April does tend to be a much better month for technology, so we'll see. Anyhow, you can see right before our eyes, market getting a little bit better this morning. NASDAQ, S&P, Dow, all now moving closer to the flat line. Everybody have a great day. Be back tomorrow over at Stock Charts TV for the next Trading Places Live. Have a great day, everybody. Happy trading.